In this video, I want to go over a few order flow tricks that I use every single day. Now, these tricks are going to help us understand who is in control of the market. Is it the buyers? Is it the sellers? Not only is this going to enable us to take better, high quality setups, but also what I think order flow really has a good benefit in doing is making sure we are not trading on the wrong side of the market. So it could also be used as a defensive mechanism to make sure that we're only opening up a position when buyers or sellers are in our favor. It's first very important for me to determine who is in control of the market. On the candlestick chart here to the right, if the market is aggressively selling off, I want to be able to gauge, are the sellers strong or are the sellers weak? Because if the sellers are weak, who are causing this market to move lower, the likelihood of the market rallying and bouncing and having a reversal would be much higher. However, if the sellers who are causing this market to drop here are very strong and aggressive, then the chances of having continuation down much lower is going to be very, very high. Being able to determine how strong the participants who are the driving force in the market could give us a good indication whether a continuation is likely or a reversal is coming. Now, in this example, to the candlestick chart to the right, we see the market making a high around 67.28. This is a 1 minute chart right here, and making a low down here around 67.06. The chart on the left is a heat map followed by essentially a time in sales. It just shows volume dots in relation to the price they're getting transacted with. And we can look at this as completed transactions, meaning any large red volume bubble indicates large aggressive sell orders coming into the market. And any green bubble, whether it's small or large, indicates aggressive buyers coming into the market. Now, these charts are identical, they're symmetrical, and this is just showing us the volume pattern behind the driving force of this candlestick chart. Now, one thing that really catches my attention here, and this is going to work better in a trending market to gauge whether we should play a reversal in a trend and play a counter trend, or whether we should play a continuation setup and the market's going to continue moving in that direction. In this example here, we can see around 67.18, a very significant outlier in terms of a large aggressive seller coming into the market with this volume bubble here. Another one directly under it around 67.17, and even some more down here around 67.13. We know that the market is selling off, and these charts are identical. And what caused this large red candle to the downside is all of this aggressive sellers entering the market in this general range right around here. Now, pulling up a delta footprint. If any of these concepts or terms may confuse you, I would recommend checking out the order flow series that I have on my YouTube channel. It breaks all this down in simple terms. This essentially is a delta footprint chart, and this shows us the same information. As the candlestick chart is selling off, I want to gauge what is going on behind the candles. And looking at a delta footprint chart, what delta shows us is either the buyers or are the sellers more aggressive over the other. And in this example, similar to what we saw on the bubble chart or the heat map, we can see around 67.18, 67.16, or 67.17, large aggressive negative delta here, indicating that very large aggressive sellers are coming into the market, and this gets transacted in this range right here, followed by this aggressive sell-off, and we can see the cumulative delta for that specific bar also expand, meaning the selling volume is expanding to the downside. In this context, using order flow, we can say that the sellers have complete control under this 67.18 level, simply based on all the aggressive sellers that have caused the market to move down. What I like doing is I like putting myself in the position of other traders, right? So if the market's selling off and I see a lot of aggressive selling volume coming into the market, I'm putting myself in the shoes or the position of these traders. And if I'm selling the market here, as long as the market remains under 67.18, I know that if I'm a seller, I'm in control and I'm essentially in profit in the market. So I have no reason to worry as long as the market is under all of this aggressive selling if I am a bear and if I am a seller in the market. Now, when we add other tools such as low volume nodes, right? A lot of traders would call this a fair value gap. They would see a very large sell-off like this red candle, they would mark something like this and they would probably call this a fair value gap. But the real reason why fair value gaps form is simply because the market had this equilibrium, or it was an imbalance of one side of the participants. In this example, where the sellers were super strong, causing the market to move down very aggressively. And in the shape of a volume distribution, which is this volume profile right here, we can see an area of low volume around 67.13. And I would mark it all the way up here to about 17 to the 18s, which also aligns perfectly and validates what I just said about all the aggressive selling coming into the market. Why low volume nodes form, or ICT traders will call it fair value gaps. Why they form is because of how aggressive the selling volume is coming into the market, leaving a low volume node. And we can validate this by all the aggressive trades hitting the bid, denoted by the red bubbles to the downside. So when we stack different confluences, we have aggressive sellers. We can see the strong aggressive selling volume. We see the large volume trades hitting the bid. And we have a low volume node. It would be very safe to say in this context, in the market downtrending, again, the trend is very important, that sellers have control under 67.18 to 67.13. It's important to know who is in control. Because if we are now looking to be a buyer in the market and we see the market trying to lift and rally here, strictly looking only off of a candlestick chart alone, not doing any order flow analysis, this chart honestly looks bullish. We are printing in a higher low and we are putting in higher highs, and we start to see a lot of aggressive buying volume coming in, and so two strong green candles to the upside. This looks like a nice valid reversal to the upside if we didn't put emphasis on the order flow and we were only a price action trader without looking at volume. Now, why this is significant, because like I mentioned, knowing who is in control, this will also help us avoid taking setups that we normally would be taking. A price action trader, I would say with a lot of confidence, most likely would be trading this to the upside and would assume the market is bullish, looking to reverse to the upside. But as an order flow trader, we know that the sellers have complete control under these 67.18s, under these 67.16s, and most importantly, even under the 67.13s. So we know until the market can break above it and then hold it as support, the sellers will remain in control. What this looks like on the candlestick chart now, a 5-minute chart, we can see the same exact thing. Here we have all the aggressive sellers from the market earlier, now seeing the market try to lift, knowing the sellers are in control. Despite this market trying to move higher, there's absolutely no way I would be looking for a long, trying to catch a reversal, and B, I would have to go in with the mentality of whoever sold to the market off earlier now should defend prices, do everything to resist the market from rallying, because those traders don't want to be put in pain, and those traders want to do everything to defend these levels where the market could possibly reject, because that's where all the large volume is coming in. Now, eventually the market for about 45 minutes time again tries to rally. We see the higher low, we see the higher highs, we see the large green candles trying to lift the market. But what's significant here is that every single time the market tries to lift, we can denote this by large green bubbles indicating large aggressive buyers. It did not have success. If large volume is coming into the market and there's success moving in that direction, then most of the time continuation is coming. However, if in this context with the large seller that we see right here resisting possibly the market, when I see a lot of buying volume coming into the market, how I read this, and this is how an edge in a trading scenario comes in where we can look to capitalize on a valid trade, is that whoever was selling the market earlier is now going to do everything to defend the market. When the market then lifts, these traders are absorbing, and this is where absorption comes in. These traders are absorbing all of this buying volume stepping into the market. So what traders assume the market to break out, we can validate this by large aggressive buying volume into this large red bubble where all the aggressive sellers were coming in earlier, is a very good example of absorption. For someone to buy, somebody also has to sell. So when the market's trying to lift here, there's a lot of buyers coming in, they're not getting rewarded, and we could safely assume that the seller from earlier is absorbing all of that aggressive buying. We can validate this with a footprint chart. On the candle, we see the market break the high. On the footprint chart, denoted by the large delta outliers, this is again, I use a 20-tick footprint chart and I use a delta footprint chart. We could see the market lifting, right? And looking at the delta bars, the buying volume is not expanding. And despite delta outliers are denoted by the brighter blue bars. We could see 212 here, 223, and then 205. And then we see another one here for 307. Keep in mind, this is directly where this large selling volume was. If I extend the line this way, we're right at it. So this to me shows that whoever sold to the market earlier, right, is now resisting the market and absorbing all of the buying volume stepping into the market. And this is weak buying volume being absorbed by this passive seller that was in the market earlier. On this candlestick chart, it looks bullish, right? This thing looks like it's going to reverse and break out. But this is where a high probability reversal that I look to enter the market and capitalize on, where there's trap buyers, there's absorption at a level where sellers are in control from previous price action. So knowing where they're in control, knowing the volume getting transacted around it could give us a high probability setup. And this is where the reversal came. And it also came at the purple line, which is VWAP, but also other good entries were here and here, right? These are all valid entries from where the seller was present earlier by these delta outliers and these trap buyers. Now, another good example to know who is in control, this is a little bit of a different example, is just a daily low volume node. So here we could see the market. This is a 30-minute chart, but the volume structure is based on the daily time frame. Here we can see a low volume node around 6908 but 6900. So it would be very safe to assume that on the following session, any dips down into the 6908 to 6900 level would be a good level to gauge if buyers are there, and would be very safe to assume if the market does sell off and we start aggressively moving lower, that this would not be something that I am looking to take the market short if we are still remaining above this low volume node. Again, this could also be used as a defensive mechanism to make sure we are trading on the right side of the market. So if we open up outside of the range and the market does sell off into this, this would be A, where I'm first looking to find buyers, and B, if the market is downtrending here, there's no way I can look to play long still above the low volume node, only once it does break to the downside. Now, if you're new to my channel and you do not already follow me on my Instagram, I would recommend clicking the link in the description of this video to follow me, because on here I post daily trading recaps along with really good trading tips and tricks that I just guarantee you're not going to find anywhere else. The link for this is in the description below of this video. And this is where in my pre-market plan, I got to look to long a pullback above 6910 to 6900, where buyers appear targeting 6920, which was just the pre-market high. So essentially it gives me, I don't want to say a bias, but it helps me know who is in control. There's obvious buyers in control from the previous session, and I don't, if I'm looking for a longer time frame trend, again, this works better for trends, I don't want to be bearish above this level. Now I'm going to show you two different scenarios here. The first one is going to be where the market bounces the first test of 69.10. And I'll show you a second test when the market breaks under this low, right? We break under this previous intraday low. And I'm going to show you how to use delta to our advantage. 69.10 is our level. I'm going to mark it out by this line. Here's our first test. On our first test of this level, we can see the market aggressively selling off into this. And the first test of this, we could see large aggressive selling denoted by this large delta right here. When I see a lot of delta or a lot of volume coming into the market and there's no aggressive follow through, or there's no downside follow through, and especially when the opposing participants come into the market, this is where a solid reversal where I can look to play along, especially it being at my level of interest. So here we could see a large selling volume coming in. And as soon as we come to this level, the selling gets absorbed and the opposing participants come in, denoted by these blue bars indicating aggressive buyers stepping in. And then the market rallies from this. Now, a little later in the session, the market's going to break under the previous low. Keep in mind, 69.10 is our level of interest. And we break under this level, again, with aggressive selling volume. And at one point, this was an aggressive sell bar, which got bought up. And by the time this bar closed, we see a little bit of a lower wick on the bar, followed by a lot more aggressive buying coming in after, indicating that this move was absorbed and the aggressive buyers stepped in, supporting the market at this level of interest. Again, when you add context and a level of interest, this is kind of when all the pieces of the puzzle come together. And then we could even use cumulative delta, CVD. I don't use this that often, but this is a very good visual. Here's the previous low, right? As the market breaks under this low, look at the cumulative delta. I mean, the low down here was around negative 1500. And as the market broke down over here, it was about negative 2000. So there wasn't a significant divergence, which caused the market to sell off on not significant selling volume, indicating that the sell-off would be more likely to reverse and less likely to continue selling off because the selling wasn't as aggressive as it should be, breaking under a low a day, and then the market reverses and continues up after that. And we could even see this by volume by time down here, solid lower wick, and then a reversal to follow that move. And I think that's going to wrap it up for this video. If you have any questions, let me know in the comments, DM me on Instagram, and any other order flow videos or suggestions you may have for my channel, let me know in the comments below. If you got any value out of this, hit that like button. But besides that, I'll see you on the next one. Peace out.